And that's the closing bell on Wall Street. As you're seeing in the bottom corner of your screen, the Dow, the Nasdaq, and the S&P 500 net positive to close out today's activity. We were mixed at one point, but we end up in the green across the board. The Dow up by 100 points, 103 points to be exact there, 0.3% higher on the day. The S&P 500, you also saw that move higher on the day. And then additionally, the Nasdaq composite looks like it gained by about 1.5% on today's activity. Brad Smith here with Rochelle Akufo and Dave Briggs. And just as we've seen the markets close, let's also bring in our panel for today. We've got Lenore Hawkins, who is the chief macro strategist over at Tematica Research, as well as Jim Caron, who is the fixed income portfolio manager over at Morgan Stanley Investment Management. Great to have you both here with us today. I want to dive right into it, Lenore, particularly the housing market. If we can begin there, because you're talking about some of the flashing warning signs that we should be paying close attention to. We do know that home sales dropped, existing home sales, by 7.2% in February. Why should we be paying close attention to this measurement?
Well, that was a 6-month low, and every single region actually was posting declines. And the median home price, while it rose 2.1% month over month in February, what we're seeing is that home prices consistently are getting so out ahead of the ability to purchase them, right? When we see wages not keeping up with the pace of the growth in home prices, there's something to worry about. We've actually seen the year over year trend in the Case-Shiller 20 City Home Price Index has topped over the peak we saw back in the late 2000s. That last housing bubble, we're getting an even bigger bubble this time. So the big concern really is that affordability has dropped towards levels that were last seen at the end of the last Fed tightening cycle. And think about what that means. At the end of the last Fed tightening cycle, that meant at the end of the increase in rates. And right now we are just starting to increase rates. So as rates go up, that means it becomes even less affordable, right? Because your mortgage is more expensive. And that's probably why we're seeing now just about 29% of sales are going to first-time home buyers. And normally home prices outstrip inflation by roughly 2 to 3 percentage points. Today, they're going at 11 percentage points above the rate of inflation. I mean, that's just crazy. Home prices are running at nearly triple the pace of wage growth. Simply not sustainable. And then as we look forward to what's being built, we see single family housing starts are up almost 14% year over year, while sales of single family housing is down 2.2% year over year. That indicates kind of a reversal that's probably on the way. And lastly, the ratio of starts to sales. Now that tells you what's happening today versus what we can expect in the future is nearing the levels that we last saw in the summer of 2007. And I think most of us remember what happened right after that.
Yikes. Let's hope that is not a repeat on the way. Very little inventory out there. Hopefully we'll keep those numbers up. Jim, I want to ask you about the big stock story of the day. Of course, Elon Musk, 9% control of Twitter, sending Twitter up 28%. What's he up to, and are you buying Twitter?
Well, I mean, I look at the fixed income markets primarily, so I'm not buying Twitter in any of our portfolios at all. But it certainly is it is a meaningful story, though. That's for sure. It's eye-catching.
And Lenore, I want to bring you in here, as we obviously have seen a range of predictions when it comes to recession fears. What is your prediction, and how should people be really balancing their portfolios at this time to manage that?
Well, we've got a lot of warning signs. Speaking of the bond market, over the past year, we've seen an acceleration in Fed rate hike expectations. Obviously, they keep talking about it. We see rising inflation expectations. We just got that again out of the Michigan Consumer Sentiment Index. And we're seeing an actual decline in real rates. And on Friday, we saw the two-year Treasury go above the 10-year. It's the first time that's happened in quite a while. That's also a signal when the yield curve inverts. That's another warning signal. It's not a timing one, so don't think that that means a recession is imminent. But what it is it points to where we are in the cycle. And it's basically saying we're kind of in like the 8th inning of the cycle. And back to seeing the accelerating rate hike expectations, rising inflation expectations, and declining real rates, that really doesn't happen very often. That occurs less than 4% of the time, going back about 2.5 decades. And historically, equities following this have seen below average returns. And two of the last times that we saw these three things happen together, there was actually a recession. So for investors under these conditions, what works best is historically been those kinds of defensive real estate, utilities, consumer staples, and healthcare. And those are actually what we've also seen outperforming year to date, the more cyclical things like industrials, consumer discretionary, financials, and materials. And then when we're thinking about a recession, don't forget the magnitude of what is going over in Europe with the war. We've already got enormous price pressure on food and energy, and that accounts for about 22% of consumer spending. So you've had a huge increase in those two things, and that means basically it's a big tax on the consumer's wallet, right? There's less left over for discretionary things. And now this war is, while the headlines are kind of talking a little bit like it's maybe getting less severe, what happened over the weekend, I think that's only going to put more pressure on as the Russian troops were retreating from some areas, finding what looks to be potentially indications of some very serious war crimes. That is putting additional pressure on Europe to really cut its consumption of Russian energy, and that is going to be brutal to do. Overall, while in the US, like our imports and exports to Russia are not that big, for Europe, it's a very, very big number. And that, you put that all together, that is just more pressure on pocketbooks.
And so that's a significant point, Lenore. Jim, with that in mind, when do you believe it would start to show up in some of the economic data if we did see U.S. companies most heavily impacted by any type of consumer movement in Europe as a result of the international conflict and the rise in prices that they're seeing? When would that show up in the data on some of the U.S.-based companies that are most dependent in their growth and even in their employment and seeing revenue that they can pass through and see profits that ultimately helps out with their employment and so forth? When would that show up in the data here in the U.S.?
Well, there's a couple things. I think the first thing is that we're going to look at the global PMIs or the ISMs, the Purchasing Manager Surveys. And what we're already starting to see is that things are starting to cool, even on a global basis. But we're not at levels yet that are sounding alarm bells. It's just that some of the overheating is starting to come down a little bit. And I think that's probably okay. And it's by design. I mean, the Fed is hiking interest rates. The ECB is thinking about it. The Bank of England is doing it. So it's okay in the sense that it hopefully will control inflation and rein in inflation risks. But the other thing that we have to focus on quite a bit, and I always think about things in terms of cash flow, free cash flow in particular, is that if earnings expectations start to come down, if we start to see revisions, meaningful revisions downward in terms of earnings, that would match essentially and be highly correlated with GDP expectations also coming down, so economic growth expectations coming down. That's when I think that we start to think about seeing a more protracted type of a slowdown. It doesn't necessarily mean that we have a recession. What it really just means is that we have economic activity that starts to decline, and it'll probably show up in earnings. Obviously, margins is a big issue as well. One of the things that's kept the equity markets relatively bolstered has been that profit margins have been wide. Companies have been able to pass through higher prices. To the extent that that starts to wane and that starts to falter, these are the cracks that we're starting to look for. They're not necessarily fully there yet, although we are seeing these signs start to appear. It's just not at a critical point. And I think that the real measure that we have to focus on here is what's happening with inflation, because that's really going to be what guides policy, and that's going to give us information as to what the Fed may do, how aggressive they may be, and that obviously feeds into earnings and margins and everything else.
Jim, how aggressive do you think the Fed will be in the next two meetings, and do you see a soft landing for the economy?
Yeah, so I think the Fed's going to be pretty aggressive. I think they're going to do 50 basis points in May and 50 basis points in June. I think the Fed is willing to risk a soft landing in order to rein in inflation risks. And I think this is one of the biggest changes in their policy reaction function, is that they're no longer as concerned with the unemployment rate, or they're no longer as concerned with growth. You know, they think that the jobs market is plenty strong, and they think that the economy is still reasonably strong, that it can withstand multiple rate hikes going forward. So I think the policy reaction function from the Fed, meaning what they will do, is that they are willing to risk not only a hard landing, but they may even be willing to risk a recession at some point, and maybe that's in 2023 or 2024, or maybe it's further away from that. But they're willing to risk it in order to get inflation under control, because they believe that if inflation runs out of control, that they're just going to have to do more later, and that creates a deeper slowdown later. So you might as well take your medicine now.
And Lenore, do you agree in terms of like the level of concern, considering how much is within the Fed's control and outside of it when it comes to interest rates and policy tightening versus, say, some unexpected events or fallout from the Russia-Ukraine crisis?
I totally agree that the Fed is likely to be quite aggressive. I mean, we're even hearing doves like Mary Daly over the weekend talking about a 50 basis point rate hike. So I think they are going to be really aggressive. They tend to be behind the curve, and they tend to never really be successful in that soft landing. I'm not sure what choices they have right now, but it's one of the challenges we have when we talk about inflation, because inflation means a lot of things. Right now, what we're dealing with is prices are high because energy costs have gone through the roof. And that is the cost of moving things around. You know, energy is the core of everything in an economy. But it's going to be really tough for them to manage this, because while we keep hearing how the economy is doing really well, real disposable personal income has contracted now for 7 consecutive months. The last time we saw 7 consecutive months of declines was from December of 73 to June of 1974. So this isn't a typical kinds of things to do. And real after-tax incomes have dropped at an utterly epic pace of nearly 5% annually. We still haven't recovered all the pandemic job losses. So we're still about 1.2 million below where we were back before the pandemic started. So that hot job market, maybe not exactly everything that we're hearing it is. And yet the Fed has to thread the needle with inflation.
Quite the balancing act indeed. A big thank you to our market panel, Lenore Hawkins there, Chief Macro Strategist at Tematica Research, and Jim Caron, Fixed Income Portfolio Manager at Morgan Stanley Investment Management.